Hello, dear students. So, as you know, we are continuing with our chapter 4, that is of business services. And in our last two lectures, we have discussed about the bankings and about the insurance. And we have already discussed about the principles of the insurance, like utmost good faith, insurable interest, indemnity, proximate cause, subrogations, contributions, and mitigations. These were our principle of insurance. So in today's lectures, we are going to discuss about the different types of the insurance and difference in between of them. So first, here you can see we have divided insurance into two parts. First is of life insurance and second one is of general insurance. And again, general insurance can be divided into three categories as of marine insurance, fire insurance, and other different type of insurance. So here in this lecture we are going to discuss about each type of the insurance with the help of example. So first we will start with the life insurance. So what is life insurance? Here people have different requirements, okay, and therefore they would like a policy to fulfill all their needs, okay. Here in our country we have different pupils and we come with different requirements with different needs, and we have different ways to fulfill all our needs. So basically we used to opt the insurance policy which can fulfill our requirements. So here first we have to find out the reason why we need life insurance, which type of requirement we can fulfill with the help of insurance policies in the future. So here we have different needs like family needs, children's needs, old age, and special needs. Okay, we take insurance just to save our family with any financial crisis. So here, if we are talking about the family needs, later on just after the death of earning members, how that family will survive. For that we can take insurance policies. And for the children's need, it means for their educations, for their marriage and all, we can take insurance policies. And old age, after the age of 60 or 70, when we will not be able to do any kind of work and there will be no source of income, then how we will fulfill our requirements or the needs, okay. That is a kind of insurance, that is a kind of pension plans. So that is of old age and some special needs may be there. So just to meet all these needs of an individual, the insurer means insurance company, have developed different type of products. Basically all the insurance policies, that is called product, okay. Just like here we have whole life assurance, endowment type plans, combination of whole life and endowment type plans, children assurance plans, and annuity plans. So we have different type of the plans. So here first we have to discuss about the whole life policy. What is whole life policy? In this kind of policy, basically the amount payable to the insured, it means a person who take insurance policy, will not be paid before the death of the assured. Whatever assured, it means that is of amount, okay, amount of the compensation or the amount of insurance. The premium will be payable for a fixed period, it may be the 20 years or 30 years, or for the whole life of the assured. If the premium is payable for a fixed period, the policy will continue till the death of the assured. So, whole life policy, it means in this policy we are not going to receive the amount of compensation before the before the date of death of the insured person. Okay. So in this policy we have to pay our premium 20 years, 30 years, or the whole life. If we have paid premium up to a fixed period, then even we will receive compensation amount after the death. After the whole life policy, we have next, that is of Endowment Life Assurance Policy. So what is assurance policy? Any insurance company undertakes to pay a specified sum when the insured attains a particular age or on his death, whichever is earlier. So here we have different thing. In the endowment life insurance policy, जो भी हमारा इंश्योरेंस कंपनी है, जो हमारा इंश्योरर है, दे अंडरटेक टू पे, वो एक्सेप्ट करते हैं, दे प्रॉमिस टू पे अ स्पेसिफाइड सम, specified amount or the amount of compensation when the insured attain a particular age. It means when a person, when that insured will reach up to a particular age or death, whichever is earlier. Just like we have taken insurance for the 20-year, so insurance company will pay rest full of the amount of the compensation or the amount according to the agreement after the age of, after the 20 years or after the death, whatever will be earlier. Okay, the sum is payable just after the death, after the death of assured, okay, insured. The sum is payable to his legal representative, or they are called nominee in the general language. In case of death of the assured, otherwise the sum will be paid to the assured after a fixed period. Okay, so here we have to find out a basic difference in between the whole life policy or the endowment life assurance policy. In the whole life policy, you are not going to receive insurance amount. Only your legal representative or nominee will receive that amount after the death of insured. But in the endowment life assurance policy, that insured will get insurance amount after the completion of particular time period, after the getting that specific age or death, whatever will be earlier. Next we have joint life policy. So what is joint life policy? This policy is taken up by two or more person. When two or more person take any kind of life insurance policy together, then it is considered a joint life policy. Just if we are running any kind of partnership business, in that case all the partners take, they can take common insurance policy. Okay, and that common insurance policy will cover all the losses of their lives and all. Okay, the premium is paid jointly or by either of them in installment or lump sum. So they have to pay the premium amount, they can pay in lump sum or in the installment. The assured sum or the policy money is payable upon the death of any one person to other survivor or the survivors. Just like we have three friends and we have started our business in partnership and we have taken joint life policy. So in that case, in the case of death of any one of the partner, rest of two partners will get the compensation amount. Okay, usually this policy is taken by the husband and wife jointly or by two partners in partnership firm, as we discussed, where the amount is payable to the survivor on the death of either of or the two. Okay, the next after joint life policy we have annuity policy. What is annuity policy? Under this policy, the assured sum or policy money is payable after the assured attains a certain age in monthly, quarterly, half yearly or the annual installments. So basically this policy is called retirement policy. Okay, in this policy, assured will get a certain amount after the specific period, and that amount he can receive per month, quarterly, half yearly or the annually. Okay, and the premium is paid in installment over a certain period or the single premium. So for getting annuity policy, you can pay your premiums in lump sum or you can pay that in installment. Okay, this is useful to those who prefer a regular income after the certain age. It means if you required a fixed income after a specific age, okay, that is called retirement age. So in that case we can opt or we can go with this annuity policy. Okay, so here we have discussed about the life insurance policies. How many insurance policies we have seen? Up to this, we have seen about the whole life policy, in which we receive amount after the death of assured person. Endowment life insurance assurance policy, here we receive amount after the specific date or duration or the death of assured. Okay, joint life policy, when two or more persons take insurance policy together, that is called joint life policy. Annuity policy, we can opt on is annuity policy if we are looking a regular income after the specific age, basically that is called retirement age. So next we have children's endowment policy. This policy is taken by a person for his or her children to meet the expenses of their education or marriage. When any parent take insurance policy by the name of their son or their daughter just for their educations or for their marriages and all, so that is considered a children's endowment policy. The agreement states that a certain sum will be paid by the insurer when the children attain a particular age. Okay, it may be the 18 or it may be the 21 or it may be the 25, like that. So when the age of the child will be in this categories or in this age, then assured will receive the amount. The premium is paid by the person entering into the contract. According to the contract, we have to pay the insurance premium amount. However, no premium will be paid if he dies before the maturity of the policy. And the very important thing about the children's endowment policy, if the insured person uh, has died before the maturity of this policy, then even insurance company will provide full compensation amount according to the contract. Okay, it was about the life insurance policy. Then next we have to discuss over the fire insurance. So fire insurance, it means when insurance company took the responsibility to pay off some consideration or any kind of amount of loss just because of the fire. So here fire insurance, that is a contract whereby the insurer is consideration of the premium paid. Definitely for any kind of insurance premium we need to pay consideration and undertakes to make. So what actually insurance company promise? To make good any loss or damage caused by the fire. So the loss or anything should be happened just because of the fire only during a specified period up to the amount specified in the policy. So basically we take such a kind of insurance for 1 year or the 2 year, just like we have taken insurance of our cars or the bikes. Okay, that is only for the 1 year. If our car or the bike met with an accident in between that duration, then only we will receive compensation amount. After the passing of that duration, we have to renew our insurance, otherwise we will never get any kind of compensation amount. So normally the fire insurance policy is for a period of 1 year, after which it is to be renewed from time to time. The premium may be paid either in lump sum or in the installment. Most probably we used to pay premium amount in lump sum, okay, under the fire insurance and all. A claim for loss by fire must satisfy the following conditions. Once if we lost our goods or anything just because of the fire, then we have to satisfy our insurer by the following things. First, there must be an actual loss. Nothing should be manipulated. Actual loss should be there. Fire must be accidental and non-intentional. Okay, so it's fire, the source of fire should be accidental. If we have made such a kind of things which can increase the chances of fire, in that case we can't claim for the insurance for the compensation amount. The risk covered by fire insurance contract is the loss resulting from fire or some other causes, and which is the proximate cause of the loss. So here under the fire insurance or under the insurance, company used to bear the amount of loss only. They do not bear any kind of profit. So it was about the fire insurance. Then after we have marine insurance. So marine, that is a kind of service which we opt at the time of import and export business. The insurer guarantees to make good the losses due to damage to the ship or the cargo arising out of the risk incidental to sea voyage. Okay, definitely whenever you will export goods or whenever you will import goods, during the travel, during the voyage, there may be the loss. Okay, so that risk can be covered with the help of marine insurance. In this insurance, the insurer in this case is known as the underwriter, and the certain sum of money is paid by the insured in consideration for the guarantee protecting he gets. So according to that agreement, you will receive your compensation amount. Marine insurance is slightly different from other types. Basically, marine insurance, we have different type of insurance comes under the marine insurance, just like ship or hull insurance, cargo or goods insurance, or freight insurance. Okay, so what is the meaning of ship or hull, cargo or goods or freight that we have to discuss? So here ship or hull insurance, since the ship is exposed to many dangers at sea, definitely during the export or import, during their voyage, okay, there are lot of things which may be the reasons behind the destroying of that ship. The insurance policy is for indemnifying the insured for losing caused by damages to the ship. So in this insurance, whole ships are insured. Then we have cargo insurance or the goods insurance. The cargo while being transported by ship is subject to many risks. Cargo, it means the goods whatever we use to send one to another places. These may be at port, risk of theft, lost goods, or on voyage, etc. There are a lot of risk. Okay, thus an insurance policy can be issued to cover against such risk to the cargo. So first we have seen ship insurance. It means in this insurance, whole ships are insured during their voyage, during their transportation. If anything happens, just like ship ka accident hona and all, in that case insurance company will pay the amount. Second is cargo insurance. It means here we can insure just only the goods, because goods may be lost by the different reasons at the different places. Just like now on the port, our goods can be stolen, and there may be the lost, misplaced and all, so that can be covered by the cargo insurance. Last, that is freight insurance. If the cargo does not reach the destination due to damage or loss in the transit, the shipping company is not paid freight charges. Okay, so suppose if we have sent something to Sri Lanka, okay, so there may be the chance of damage or the loss of goods and all. So suppose अगर loss हो जाता है, goods destroyed हो जाता है, कुछ हो जाता है during the transportation, so in that case that shipping company will not be in the position to pay off the freight charges. Okay, freight insurance is for reimbursing the loss of freight sorry, to the shipping company. So freight insurance is there. If we have lost anything, if we have lost goods during the transportations, so in that case we don't have to bear the freight charges. That freight charges will be bear by the insurance company, but for that we have to take freight insurance. Okay, here we have differences in between life insurance, fire insurance and marine insurance. First we have to find out difference on the basis of subject matter. As we know, the subject matter of insurance is human life under the life insurance, because we insured, because we provide safety to the human life. Second, fire insurance. In the fire insurance, the subject matter is any physical property or the assets. In the marine insurance, the subject matter is a ship, cargo or the freight, as we have discussed. If we are talking about the elements under the life insurance, so life insurance has the element of protection and investment or both. Most probably we take life insurance policy for the protection purpose as well as for the investment purpose. But fire insurance, that is only one element, that is of protection. Okay, that is not for the investment purpose. And same thing with the marine insurance, the main element of marine insurance, that is of the protection, not the investment. And here in the life insurance, there was a principle that is called insurable interest. Insurable interest must be present at the time of effecting the policy. Once when we have taken insurance policy, at that time insurable interest must be there. Okay, but here in the fire insurance, insurable interest on the subject matter must be present both at the time of effecting policy as well at the time of claimings. Both of the time subject matter should be there. Then marine insurance, insurable interest must be present at the time when claims falls due or at the time of loss only. Okay. Then duration, the life insurance, basically we take life insurance for 3 to 30 years, 40 years, or maybe 5 to 30 years, like that. But fire insurance, that is not exceeds more than 1 year. And marine insurance, that we take just only for a specific way, that is of voyage, that is of the transportation. Then here next, in the life insurance policy, the presence of indemnity. Life insurance is not based on the principle of indemnity. The sum assured, that is amount of insurance, that is called sum assured, is paid either on the happening of certain event or on the maturity of the policy. You will receive your compensation amount, which is called sum assured, at the time of happening of some activities or at the maturity of policy. Fire insurance is a contract of indemnity. It means you will receive the compensation amount if loss will happen just because of the fire. Okay. And marine insurance, that is also the contract of indemnity, and the insured can claim the market value of the ship and cost of the goods destroyed according to the agreement. Loss measurement. In the life insurance, loss can't be measured because we know the life of human being, that is most valuable and which can't be measured in the term of money. So under the life insurance, loss cannot be measured, but under the fire insurance, loss can be measured. And under the marine insurance, again loss is measurable, that we can measure. Okay, so here in this lecture we have discussed about the different type of the insurance. Okay, and with the examples or illustration, as well as we have seen the basic difference in between the life insurance, fire insurance and the marine